Hello, everyone. Welcome to another FinMeUp weekly wrap where we cover the most important stock market news that happened during the week, all summarized with some extra insights. Also, on the FinMeUp app, there were some really cool posts this week. The daily updates, we get these news all summarized every day, as well as methods paying your debt, a stock pick on Mondi, and an update on Karoo and Santova, and a few more. And there's the quiz. So check that out. Today, we'll be covering Pick and Pay, Santova, Renergen again, more news from them once again. And then in the US, we'll quickly look at Google, Amazon, and Apple. So first, Pick and Pay group sales for the first 10 months of the 2023 financial year grew by 9.3%. South African sales grew by 9%. The rest of Africa grew by 17%, so some nice growth there. And the group spent 346 million rand on diesel to run the generators, for load shedding. This is really impacting retailers. Coop Agri also posted an update yesterday, also saying, they are also not immune to load shedding, and it really impacts the operational costs. And we're definitely seeing this in retailers. What do you think?
Load shedding is taking a massive chunk from all of the retailers. And if you just look at the results quickly, they grew by 9.3%. That's only the sales, right? So the sales barely beat inflation. And I can promise you the bottom line did not beat inflation because the expenses are so much higher due to load shedding. You can imagine to keep the fruits, the veggies, the meats cold. And if you don't keep it cold for X amount of hours, you have spoilage. I mean, it's just a nightmare at the moment. So I read somewhere, so Pick and Pay is 60 million a month. ShopRite, I think, is 90 million a month. So just between those two retailers, it's 150 million rand a month just to keep the show on the road. And like they said here, I think the quote is, "It is clear that progress will not be rapid. The group therefore takes the view that the current crisis is a permanent new reality." And as a consumers, that's something we must also accept, that load shedding is here to stay, unfortunately, at least for the short to medium term. I spoke to Charles Buerta, and he said he asked around, why don't they just build, a few solar panels, install batteries? And the reality is that it actually gets stolen, especially in the rural areas. So now you have to install new infrastructure plus security. It's a lose-lose. No one wins. Not looking good, unfortunately.
Yeah, something to keep in mind with retailers. Next, a company that I love, a company that I wrote updates on during this week, a small cap called Santova. So Santova announced that they repurchased 4.1 million ordinary shares, representing 3% of the company's issued share capital, and the total value of the shares repurchased were close to 32 million rand. What I love about this is the management, and if you listen to their investor presentations, they are really focused on building value per share. And some of their competitors in the UK is at a PE of 8 to 13. In the US, you get up to 25. They recently acquired a company in the US. This is an international company, international small cap. 80% of their revenue, close to 80%, is from offshore. And so they don't pay dividends. They rather buy back shares because, first of all, that improves shareholders' returns through getting more earnings per share, and the EPS determines the PE ratio. So that's also good for the valuation metric. And I think they are committed to even buying back more shares. And this is one thing to keep in mind with Santova. The shipping rates have come down, and they when the shipping rates were really high, it did impact them positively. So we'll have to see how it impacts them when the shipping rates are lower. But they also highlighted that the big revenue growth last year was not just because of the high shipping rates, but also because they onboarded lots of new customers. And that value will expand as time goes on as well. Any thoughts, Paul?
Yeah, as Santova is your biggest holding,
Yes.
it is, right? So you must have a smile on your face. So just for the listeners, when a company buys back their own shares, that's always, always, always bullish. It means that they believe in their share, and they also believe that at current levels, the share price is either fairly valued or maybe even undervalued. They will never buy back if they believe the share is, overvalued. So that should give investors a lot of confidence. and rightfully so. And it's a solid amount. You go, it's 3%. It's 32 million rand. That's not like they say in Afrikaans, ligte vrugte. I mean, that's a proper buyback. So it looks like their two strategies at the moment is buying back shares and a little acquisitions that they're doing along the way, to grow the company. So if you're a Santova shareholder, well done, and let's see what happens.
Now let's see what happens. But I'm seeing what happens over the next 5 to 10 years. Hopefully they don't get bought out. Obviously that would result in a return. But this is a company I'd hold for the long term. If they have one bad year because shipping rates are lower, that's fine with me. Renergen, once again in the news. We cover Renergen every week. They post a lot of announcements. So to summarize what they are doing, first of all, what happened? There were 2 directors that resigned and 2 new directors. This is always not the best sign, but it also doesn't mean something necessarily really bad, unless it's obviously the CEO or something like that. And they also announced an accelerated book build offering. They are always on the look to raise more capital, and they're placing the new shares at 24 Rand per share, so a slight discount to the current share price. What do you take from this, Paul?
Yeah, like I said last week, it feels like Renergen is in the news every 5 minutes, and that's exactly what they want to do. And they need to stay in the news, and they need to keep the story going because they need capital, they need cash, and they need a lot of cash. And the only way to do this is either via debt or equity. And the equity portion is they need to sell their shares, and if they sell it at a low price, it dilutes current shareholders, so that's a no go. And they'll obviously then also need to sell a lot more shares to acquire the necessary amount. So they need to keep the share price high. And how do you do that? You stay in the news, you make promises, and you actually also deliver a bit. And that's what they kind of have done. This is the first time I see kind of bearish news. Directors, stepping down. That's not necessarily a good thing, but I don't know the ins and outs of what happened here. So, if you're a Renergen shareholder, just know that there's a lot of potential. Be aware of the risks.
Yeah, but definitely, be cautious. I own Renergen shares, but I know the risks that are involved. Quickly, another JC company that's a lot in the news, and that is PurpleGroup. So there's been a lot of talk around PurpleGroup on Twitter because the share price is falling. There were video or stock. I can't remember exactly where I said I sell out of my PurpleGroup when it was above 2 Rand 30. There's nothing fundamentally wrong with the business. It was just overvalued, and as all high growth companies, their valuations came down. Same is happening with PurpleGroup. They are still onboarding new clients, and then obviously there is some frustration in the markets that the products that they announced haven't launched yet, and that the Southeast Asia partnership hasn't gone live yet. So there's a bit of impatience and also just a bit of valuation coming back down to earth. If who knows where this company will be in 10 years. A lot of people call it the next Capitec. I don't think it's exactly the same, but it has a lot of potential. I'm not buying anything yet because obviously, they are correlated to the market because EasyEquities is a platform where you invest in shares. So I'm staying on the sideline, but it is looking more and more attractive. But let's see how low it goes. Looking at the US Google earnings, man, Google dropped $150 billion, close to $150 billion, just because their own version of ChatGPT made an error. $150 billion. Even the entire ChatGPT is valued at like $20 billion. So that drop was definitely something, I think, a bit too big. But their earnings per share of $1.05 missed expectations of $1.18. And the revenue also slightly just missed expectations. What do you think of Google? That it's such an interesting space to watch now, and there's going to be a lot of competition. Every corporate is launching their own ChatGPT. Salesforce launched their own ChatGPT. Google, who knows what Apple's going to do? Who knows what Meta's going to do? It's such a race to AI, and a lot of people say it's this big bust and boom, and then all of a sudden we see, okay, what life actually changed.
Yeah, I think you're hitting the nail on the head there, Ego. Every corporate out there will, in my view, within the next 1 to 5 years, develop their own version of ChatGPT because you actually have no choice at the moment. I can't see a world where you survive and thrive if you don't have a ChatGPT integrated with your service offering. So that's going to be a new reality for us. And I think there will be quite a few versions. And I think all of them will be pretty good. Obviously, there will be some that's better than others, but their offer will be very similar. And as a consumer, you won't really be able to tell the difference. The market is very excited, and we'll see what happens. It is a very exciting yet scary prospect. So we'll see how they integrate ethics with all of this. But essentially, all the chatbots are built on the same language models. So it's all based on the same baseline of how do you actually build this thing. So I'm excited, but also cautious.
Yeah, and if the Bing search, so ChatGPT is integrating with Microsoft's Bing, if that goes well, we might see Google's search becoming under pressure, and that's maybe why the share price fell that much. Amazon EPS of just 3 cents, missing expectations of 17 cents, revenue beating expectations, and they are concerned about consumer spending going forward, as they believe they will continue to prioritize budgeting so that they can get better margins at the end of the day. And Apple earnings per share of $1.88, missing expectations, also slightly. Revenue also missing expectations slightly. So definitely seeing some pressure. But then you see, in the US, they're posting great jobs report. But then you see all of these layoffs. So it's such a weird space at the moment in the US markets. For me, it's a more just wait and see at the moment. I'm not rushed to do anything. There will always be opportunities. So I'd rather preserve capital at the moment than have the potential of losing it. But that's why I'm just doubling down on my favorite stocks at the moment. Any comment on Amazon or Apple, Paul?
Yeah, just quickly. So Apple, they missed it slightly, but I read that they're still winning market share in the smartphone segment, which is amazing. I think Apple has kept us alive in the US markets, especially if you're an ETF or an index fund guy, because Apple is the one that's not really fallen more than 30% like all the other tech stocks. And once again, in my view, Apple's what they bring to the table, their massive competitive advantage is the ecosystem. Now, once you go Apple, so that's very, very powerful in terms of their offerings, the integration, and also the loyalty from the customers. And then what you said regarding the macro cycle, where are we at the moment? So there's a massive debate online between retailers, between experts, professionals. Where are we at the moment? Have we seen the low, or are we just about to really hit the lows? Because we've seen a little bit of a rally the last month or so. We are terrible at predicting the future. I'm not going to lie and tell you I know what's going to happen. I know what I think is going to happen, but there's a big chance that I can also be wrong. So that's why, for the viewers, the best strategy is always don't throw the kitchen sink at everything. And the best strategy, the best proven strategy, and this is financial advice in the sense that we've proven this over time, is dollar cost average. Because then you never run the risk of throwing a lump sum to something, and then if you get the timing wrong, you're basically screwed for the short term. So DCA, sit back, relax. There's no risk of wrongly timing the market. The market will recover. That we know for a fact, because we have 100 years worth of data. And then it's just not a stressful process for you. You can just sit back and you will make your money. You will make your money via that strategy.
Over the long term, yes, and investing in quality companies or in ETFs. The interesting fact is, I don't think we've ever seen the bottom while they were still raising interest rates. So this might be the first, or we might see another leg down. That's why I'm a bit cautious at the moment, but we'll have to wait and see and not think about this unless you are a trader, but not think about it on an every day-to-day basis. What should I buy? Should I sell? Should I buy? Should I sell? Rather, just be patient. Dollar cost average is a great strategy to consider. Think long term and safe investing. Remember, you don't need a lot of wins in your life. You just don't need to lose that often. That's one of Warren Buffett's quotes. Have a great day. Thanks for watching. Check out the FinMeUp app. Check out the rest of the links. You can also book a free call and ask your questions to Paul right here. So I hope you have a great weekend. Cheers.